The Crotchety Old Men podcast is not a registered investment, legal, or tax advisor or a broker-dealer. All investment financial opinions expressed by or on the Crotchety Old Men podcast are from the personal research and experience of the owner of the site and are intended as educational material. Although best efforts are made to ensure that all information is accurate and up to date, occasionally unintended errors and misprints may occur. Before you invest or make any investment-based decisions, consider your own personal circumstances. You should do your own research and seek advice from a financial professional.
Welcome again to the Crotchety Old Men. Hello, hello, hello. Hey, look here. This is Gary Smith, one of the hosts here at the Crotchety Old Men podcast. Greetings, everyone. In the studio today, I got all my comrades with me. My main man, Paul PC Clemens, in the house. And
Hey,
George, hey, PC, what's cracking?
ain't nothing to it but to do it, baby.
All
It's
right, all right. We
beautiful,
got
beautiful day. Need to be out there on that golf course.
Oh shucks. Let me bring George in. George, what you talking? Y'all talking golf. George, help me.
Hey, good morning, guys. How y'all doing?
Man, we're
All
doing all
right,
we can
doing
and
all
even
right.
went twice.
Good, man. It's good to have all three of us back together. Last couple of episodes, you had you guys. I think y'all was out playing golf, so I had to kind of wing it by myself. But I think we did a great one. So this is just the icing on the cake. Time to get it at it again, man. We got a super duper topic for today. You kind of want to lead us through it, Gary?
Yeah, man, let's get this kicked off. Um, we all know that, let's say in the last quarter, particularly starting in this quarter here, as we move and attempt to navigate through what some people perceive as a bear market. And being frank about it, yes, I guess it would be somewhat of a bear market and when you talk about stocks, your bonds, your equities, and things of that nature. But we're going to discuss today, what should we be thinking? How should we be thinking in terms of balancing our portfolios, in terms of diversifying our portfolio for that matter? What's out there? What tools are available to us today that we can take advantage of, capitalize on, monetize to our benefit? So, fellas, hey, let's dive on into this.
Yes, me some very good points. We are trying to provide some information that's going to help you navigate. And like I said, the most important words you use is diversification. I think in this era, it's very important that you diversify and you use the tools that are available. Whether that's a savings account, whether that's your stock portfolio. So kind of let's first look at that. When I say savings account, uh, right now you've got a couple of money markets out there that are paying a decent interest rate, more than your banks. I'm not going to name them, but I was looking on the internet. So some of them are up to like 3%. It may not sound like a lot of money, but it's a good holding place for the money that you have between paychecks. So if you can make a couple extra dollars at 3%, that's better than the 0.01 that any banks would be paying. So those are kind of things that you want to look for in just the day to day. Where do I put my excess money? There's a couple of other things out there that you also may want to look at. I bonds. We've talked about those in the past. I bonds are paying pretty good right now, financing all things that the government are doing. There was that 9.62% offer that was over in October, but still there's some good upside to T bonds. Remember, with the I bonds, you got to keep them for at least 5 years for full maturity, but you can sell them in between. There's just a slight penalties, but it's something you may want to investigate. And then the last thing I'll talk about from just a everyday savings perspective are the T bills. T bills are more short term. You can do them as low as 4 months with a slightly higher interest rate. Here again, just financing the government. So those are kind of things that you can kind of kick off if you're just looking for what to do on with your daily money, as opposed to sticking it in some one of these banks. What do you got? What do you guys think about that?
Well, I think that's a great place for us to start, and because it's just so important that we know what to do and when to do it. The tools are out here for us. And we just have to educate ourselves. That's our attempt here at the Crotchety Old Men podcast, as we chop it up about these type of topics, is that, what's available to us, and how can we make it happen for us. What do you think, PC?
I think that's a great idea because most of your economists talk about how they're able to make money during the bear markets, and right now we're right in the middle of a bear market. So it's a blessing to know that there are options available during that bear market where you can make money and boost your own personal economy by using these tools out here that we talk about.
Yeah, I think a couple of the things that are become our friend is one is dollar cost averaging, and the other one is compound interest or the compounding effect. So basically, what your dollar cost averaging, meaning that you're making investments on a regular basis, that being weekly, monthly, quarterly. Therefore, you're taking advantage of the highs and lows of the market. The net effect is if you're able to buy stocks at a lower price, then they'll go up. You have more shares of that stock. So the dollar cost averaging is definitely your friend. And obviously, you can use that in your portfolio at the job if you have a 401k, which is the primary principle of how you do that. And then the compounding interest effect is basically finding those interest rates and allowing that money to accumulate. The third thing I'll add to that is also dividends. Dividends, reinvesting, buying stocks that have dividends, pay dividends. They're going to continue to pay those dividends regardless if that stock goes up or down based on the earnings of that company. So these are things that you can do and look at that are going to continue to bring you additional funds in this so-called bear market, so-called recession that's going on. So you got to be kind of smart and wise as far as in looking out what's going on, as opposed to just looking at it, from a helpless perspective and not knowing what to do on a day-to-day basis.
Let's take that from a macro perspective and look at it on a micro perspective. As I talk about often, going back to our diversification piece, in that it, in the early stages of investing, diversification is certainly wise because you don't know what's going to work or not to the benefit or to your expectation and things of that nature. And so when we take a sector of investment too, such as the stock market, all right, just like there's winners, losers in the stock market, there's also winners in the stock market. And it's the education that's the most riskiest bet anyway. Okay, it's not so much what the deal is about how much you know about the deal. So what do I mean by that? Let's take a micro look at, let's say, one particular stock. And I'm not just picking on this stock for any reason other than illustration, but most people have a cell phone, whether it's an Android or a Apple. All right, I happen to have Apple, so I'm going to talk about Apple as a company, as a stock, or what have you. I don't know what Apple is trading at today, but it doesn't matter because most people are aware of Apple product. Uh, we know pretty much without even going to a stock index that Apple has continued to increase its earnings over a long period of time. And let me pause right here because as we're talking about investing and developing portfolios and things of that nature, we're looking at it from a long-term perspective. Okay, this is not a short-term game here. It's a long-term perspective. So when you do invest, or if you do invest or buy a stock, buy it for the purpose of a long-term investment. All right. So now, what do you look for? If you're going to look for, let's say, for instance, just because I have an Apple phone and that's one of my philosophies, I want to invest in what I own or what I use. For me, it's like, okay, money coming back to me. The other thing that George, you mentioned is about the dividends. Dividends, as far as I'm concerned, is one of the most crucial things that a stock or a company can pay you as a shareholder. If I gotta wait until the time whereas I'm gonna cash my stock in and take advantage of the return or what have you that may be there, then doggone it, you need to pay me for waiting because there's a cost for me not being able to put that money somewhere else. Okay. So as long as my money being tied up, I need to be getting interest or a dividend or both. Dividends typically are paid quarterly. So as we look at that stock, and again, I'm just using Apple as an example, but any stock is just your favorite. If you like, Borton's yogurt ice cream or whatever, and you find out who manufactures that, and you think people are going to forever do that for at least another 5, 10 years, buy that stock. Going back to my point, it's the dividends, like George said, that compounded, making that, monetizing that tool of that stock. And whether you buy an individual stock, and here's something I would suggest. I'm not advising anybody, but I certainly would highly suggest it. If you're participating in your 401k at work, and you see where that 401k is investing in Apple, and then also that your job is matching whatever your investment is, now you've monetized it on steroids because you meet that maximum amount that your company is going to match. If they're going to match 5%, doggone it, you invest 5%. Now you got 10% going into, yes, a mutual fund or whatever, but part of that 10% is going into that Apple stock. That can be your gauge about what individual stocks to buy. Because whoever buying those stocks for your 401k, number one, they're smarter than you. So heck, buy Apple and then buy that individual stock or whatever. What do y'all think, man? I mean, I could rattle on and on and on. I'm not a stock broker or a stock chaser, but I know how to make money in the stock market.
Well, the thing of it is, for me, is that you guys were ahead of the game as far as the financing as opposed to me. And it was that very thing you're talking about, Gary, where I started matching my 401k on the job. And that's really what got me into buying stocks and getting interested in stocks in the first place. Because I could actually see how my money was multiplying just through the matching funds part of it. So and then another thing I'd like to add to this is why we're buying stocks, we need to learn how to read the charts so that we can have some idea of when that stock is going to go down and when that stock is going to go up. And those charts tell us how that works. What do you think,
Yeah,
fellas?
absolutely. You've hit on some really good points, and I'm gonna give Smitty a chance to kind of walk through that. But yeah, that's exactly what you want to do. You don't want to go in this blindly. Here again, none of us are stockbrokers. None of us are giving you financial advice. We're basically telling you the kind of things that we have done over the years to invest and bolster our portfolios. But I'm going to tell you one thing. Remember, I talk about don't pay taxes and don't pay fees. Kind of goes into this, and one of the things that, in my experience, I'd stay away from is these target funds. These target funds charge a lot of fees, so you need to be very careful. One thing you want to keep in mind is even though you're in a 401k, there's still a fee associated with whatever fund they put you in. So you have to make sure that you examine what the fund asset class is. And I'll give you some examples of some asset classes. There could be emerging markets, there could be REITs, there could be US fixed and income, they could be small cap equities, they could be global funds. So these are the kind of things that you want to look at and educate yourself on before you just blindly start checking some boxes on your 401k. Because like PC said, that's free money anytime you have a match. So you want to make sure that free money grows for you and is not in a fund that's going to charge you high fees, but it's going to give you the type of returns. Now, in most of these in all of these funds in the portfolios, it's going to give you a tracking record, and by no means is previous performance a indication of future success. But we have to use that somewhat as a guide. So, Smitty, come walk through how we actually look at stocks and kind of determine if this is a good opportunity or not. Some of the things that
So
we need to look for.
one of the things I look at is, all right, let's see who's running the ship. Okay, who's behind, who's in charge, who's calling the shots. All right, and then how much stock are they on? So So in any, they call it a snapshot page. You can go on there and you can look at that. I call it legal insider trading. Okay, and because most people want to think that we think that, well, if a stock is about to go down, it's easy to figure that out. All you got to do is find out what the controller and the CFO and the CEO, if they're selling all their stocks, I need to sell mine too. Wrong. Wrong. People sell stocks for a myriad of reasons. Heck, it's the time to cash out. Hey, you got, one of these grandkids or something needs some money for college. You name it. It's a myriad of reasons for people to sell stocks. So that's never an indicator. Here's your indicator. How much or more are they buying? This quarter, this last month, man, that's interesting. The CFO bought 100,000 shares of more stock of Apple. That's a probably one. They wouldn't do that. The only reason that you buy more of something because you're expecting more back. Hello, come on. We have to start thinking to grow rich. That's why I love that book, but I'll come back to that later. Okay, so look at what they're doing. How much more are they buying? Is there a buying spree going on? Because the stock market, when the bell rings at 4 o'clock every day, that's a lagging indicator of what happened this morning or 30 days before then. And I wish I could go right back to the date, but Starbucks did it, case in point, about a year ago. A lot of the executives, Charles Schultz, whatever the names are, they were buying stock. And at that time, they were buying stock, the stock kind of was going down. I don't know what it is that came out, some promotion, whatever, but man, that stock shot up, and sure enough, Starbucks was a winner. So put that on steroids with dividend paying stock. Now, just because a stock pays dividend, you got to look at how much it's paying in relation to what? Inflation. I mean, heck, if Apple's only going to pay 0.5% or 2% a dividend, they making all these billions. They don't, like Michael Jackson would say, they don't give a damn about me in terms of paying me a return for waiting on them to get to a high enough level for me to cash out, as far as I'm concerned. So I'm looking personally, I would suggest, if you can't beat inflation, at least meet it. Find those stocks that are paying right now 8, 9, 10, 11% dividends. Okay? Because that's what's important right there, is how much money you make. Because here's my philosophy. Anything that varies is IFCOM. Anything that pays you interest and dividends is income. You got to know the difference between IFCOM and income. And to position ourselves for that is for us to dig deep into what this company is. Forget what the stock is doing. What is this company doing? What industry is this company in? Okay, that's number one. It's taking a top-down approach. Okay, what is the industry it is? Is this industry growing or going away? It's like the industry of cassette tapes, Blockbuster, and all that crap. Okay, there was a time when all that made sense, but that industry is gone. So let's look at those industries, narrow it down to the top 3 industries. What are the top 3 industries right now that are still going strong, regardless of the pandemic, regardless of the economy? It's going strong. Well, one of them right off the bat is energy. Okay, and I'll stop right there. Narrow that down. What are the top 3 companies that are dominating the energy industry? Boom! That's going to give me those 3. All right. Of those 3, what are the top 3 companies that are suppliers of those companies? Then you just go on the way down. And so now you have the trilogy of 3s, because all things come in 3s. No different than the sodas and all this other stuff, your big 3 automakers. I could go on and on and on. But this is how you bring the macro down to the micro in your own personal investment portfolio. Question?
Yeah, I mean, that's exactly right on, Gary. And the interesting part about that, all of that information is available for each stock in black and white on the stock page. It'll walk you through, like I said, a snapshot will give you, the price, the previous price, the expected ratio, what the other stock brokers are saying about it. It'll talk about what's in the news. It'll talk about if it pays a dividend or not. It'll give you all of the information. It'll tell you who's buying stock, who's selling it, as far as the executives within the company. So all of this information is available. There's no secret. I think you said earlier, as you described it, you said, I think you call it insider trading, but it's not insider trading because it's all right there to your fingertips. We just have to make sure we're reading and understanding what's available to us. I mean, that is so important. So, in that same vein, if you have stocks that you believe in, and I'm not going to name them because, like, it's a personal choice, and you believe in these stocks, and so say the stock is slightly down right now and you own 15 shares of it and you believe in this stock and you believe that because it's a consumer product or it's something that's going to at some point is going to turn around and go up. Say your cost basis is $16 a share, but it's now selling at, let's say it's selling at $11 a share. It may behoove you to go in and buy one or two or five or six more shares, whatever affordable. So what's that's going to do for you? It's actually going to bring down your cost basis on that entire portfolio for that stock. So if you originally bought it for 16 and you had 20 shares and you buy, say, five or six more at 11, it's kind of going to bring that cost basis down to somewhere around $13 a share. But it's going to give you more shares. So now your 20 is going to be 25. So what happens when it goes back up? You make more money. So that's another way that you can kind of, negotiate and benefit.
Another thing, George, at that point, we talk about selecting stock and bringing it down to the macro level. On that same snapshot, it's your stock that you may have belief in, what have you. It also shows their competitors. So it gives you a range of other stock to select. It takes all the guesswork out. Okay. And it shows you how much dividend they're paying, how much earnings they made, et cetera, et cetera, et cetera. But we have to we still got to latch on people to KEY. The key to success is to keep educating yourself. This information is free, it's available. I tell my students all the time, I can show you what to read, but I can't show you what to see. And so what you have to do is educate yourself by going there, going to these snapshots. Nobody's saying you got to become an expert chart reader or stock picker or whatever, because you don't know. Unless you God, you don't know. You don't know if that sucker going to go up or down or when. You don't know. Stop playing with yourself. It's a mental masturbation to even go through some crap like that. You don't know. So what you want to do is position yourself based upon the information that you have and based upon what the heck is going on around you. Okay? What's going on around you? Are they hiring more people for dog food manufacturing? Maybe. Because why? Well, because more people are working from home. Probably dogs are getting fatter because they eat more because, hey, people love their dogs. Okay? So if that's a market, then follow that market. Track that industry, track that company. Who's that supplier? Who makes dog food to begin with? How did this mess come about? Because all of that is a trail. It's called a money trail. Sometimes you can pick up stocks that's not even around, just like you can pick up real estate properties nobody even knew existed, and they're sitting right there in a gold mine. Why? Because they're not looking for the right thing. They're looking for a property rather than a profit. So the same thing we have to do. What's your motivation for buying a stock to begin with? Better be profit. If you're just buying it because you believe in it, heck, I believe in cassette tapes till I couldn't find none. they CDs now. So belief and profit, I don't know. You better find something that makes sense. CENTS on steroids.
George, you mentioned one thing that I'm kind of curious about, and that is when the companies give you a matching fund choice when it comes to your 401k, and the fees that are attributed to some of those companies that they give you. So what if you find a company, or the company that you're working for chooses a company or a 401k where the fees are exorbitant? Then what do you do?
Well, that's a good point, Paul. And first of all, we've been throwing around the word stock. Okay, so when we throw the word stock out, we don't necessarily mean an individual stock. Through our experience, we want to look at ETFs, which are exchange traded funds, or we want to look at index funds, where they're based on like your S&P 500 and things like that. So in answering your question is, You want to look at, here again, the track record of the different stocks within that company. So they're not going to put you in a stock, okay, or a fund. You're going to choose the fund that you want to be in. And I named those funds earlier. Then there's also a tool out here called the Colin, and I'll spell it. It's CALLAN, Periodic Table of Investment Returns. And they will track funds from 2002 to 2022. Okay. And it'll basically give you the track record of all the stocks and how they're ups and down, and here again, when I say stocks, all the asset classes. Maybe that's a better word that I use, which are your REITs, your emerging markets, your U.S. fixed income. And so what you do is you look into these funds and it'll tell you what the mixture is. Some may be a high cap fund, which is your top companies. Some may have some international stocks and funds in them. Some may have bonds, a mixture of bonds and other funds. So basically, what you want to do is you want to look at what the company is offering totally in their portfolio from a fund asset class, and you want to look at the price that they're charging you to invest in that, as well as the history. Because like Smitty said earlier, if they're charging you a high rate to manage that fund for you, and it's called management fund, and it's all available because it's going to tell you this is what you paid for the stock and this is how much the management fee is for that, versus the return. If they don't balance out, then you're not really making any money. Okay, that makes sense.
Oh, absolutely, George. Absolutely. You know, as we talk, and I was just sitting here thinking about, okay, so, in that page, we talk about stocks, and to George's point, he's absolutely correct. We're not just, talking about individual stock. We're talking about companies, and whether go into I mean, not REITs, the ETF funds and mutual funds, etc. So here, but let's go again, let's dig deeper. All right. For those who either don't contribute to the 401k plan for whatever reasons, or like we're talking about here about the exorbitant fees, and it's particularly those who are astute enough and have the capabilities and the discipline to do this. I was looking at the median in household income for 2021 just the other day, and the median household income for the United States or nationally was $69,717 a year. Now, as you know, median means there's just as many making above that. Obviously, we know nationally there's a lot more people making 69,000 probably than there are making less. I don't know. I may have that reverse. Maybe there's more making less than 69 than that. But whatever. Here's where I'm going with this. And I'm not. This is not a well. Okay, it is racial disparity. So I will say it. Of that number, let's talk about and race doesn't matter here. Let's just talk about what the African American median is. The median income in 2021 for African Americans was $46,774. 46,007, call it $47,000. Now, I like numbers because the numbers typically don't lie. So at 5%, typically I figured that 5%, if you say 5% of that $47,000, that's roughly about $2,300 a year. Times 5 years, that's $11,500. And I'm not even talking about any interest or anything that could have been earned. That's $11,500. So what does that come down to? $200 a month. $2,300 a year, roughly about $200 a month investment. So first of all, another thing that it shows is what's my budget for investing? Okay. After you pay tithes and things, if you believe in that sort of thing and stuff like that, and you've done that and you've done your offerings to charity or what have you. All right. The most prudent thing, obviously, to pay yourself. Okay. Pay yourself first. All right. I mean, yeah, you got to pay DTE and Consumer Power, and you need to pay GMAC or whatever. Do that too. But doggone it, hey, pay yourself first. If you're not worth 5% of the money that you earn, oh man, turn this off and go pray. Come on, man. So let's assume that you are worth 5% of whatever it is that you earn. 5% of $46,000, I just told you. Okay, so if you can invest that every year Now you know. I don't know how much an Apple stock is, but whatever stock that you like, based upon what we just broke down earlier, from the industry to the company and stuff like that. Now you can start about to put this $200 a month to work. You can either buy one stock for $200, or you can buy five of them for $20, or you can go into an ETF or whatever. But now you're putting this $200 to work, discipline every month. And now you're going to monetize on what George said earlier, that dollar cost averaging. And you have a goal, and you know that if you consistently stay on this track, 5 years from now, because trust me, 5 years is going to go by anyway. Some people right now crying, man, I remember when I was 25, here it is, I'm going on 30 years old. And so 5 years went by so fast. Don't let it be you. And if 5 years going to go by, make sure you get paid.
All good points, Smitty. And that's the whole thing that of this conversation is to make use of what you have. It's not what you make, it's what you do with what you make. And by taking a small percentage of it, paying yourself first, and some of these funds and tools that we provided to you will help you grow and help you get to that end result as to whenever you feel like retiring or calling it quits. But you've got to have a plan. I was trying to figure out when I was going to interject this, but I think this is a good time to interject it. Is life insurance. Okay. And those that have been listening to the Crotchety Old Men podcast, through our inception, they'll know that at some point in time, I always go back to life insurance. Why? It's because my spiritual brother that's where he got me started in investing. And when I talk life insurance, I'm talking about either a whole life policy or a variable life policy. In my situation, it was a variable life policy. And the reason I bring this up is because right now we know that the cost of borrowing money is high. Okay, so if you want to borrow money, you're talking even for housing at 7%. And so anything consumer goods, credit cards, it's probably if it's not double digits. And the reason I don't know is because I don't do that. I don't I don't use credit cards like that. If I'm gonna use a credit card, I'm paying that puppy off every month. So I don't know what the interest rate is. But this is my point, because I don't want to belabor it. You can if you take out a variable life insurance policy, whatever denomination, at an early age, and I hope our audience, and that's who we're primarily speaking to, our early age earners, and you pay on that, it's going to develop what we call cash values. At some point in time, and it may be today, you can borrow money against a lower interest rate than the going rate right now. You can probably borrow at around about 4%. So if you can borrow that at 4%, that's going to, and I don't want to leave this part out, you're borrowing from yourself. Okay. So when you pay it back, you're paying back yourself if you decide, because that's an option. You can pay it back or you don't. Okay. So this is money. You basically created your own banking. Okay. So that's an asset tool that kind of runs in the background. It's like that background music. Okay. You sock the money away in this policy, and it has multiple functions. So, but that one day you get to the point where, like now, I need some money. I don't want to borrow it, but if I borrow it from myself at a lower interest rate, it still serves the same purpose. So that's my tidbit. Look at these types of vehicles, because they will help you, not in the short term, but in the long term. Okay. If it's to buy a car, if it's to put a down payment on a house, because here again, this money is tax free. Okay. Because it's your money. Okay. So please take a look, at these types of programs, because they will benefit you in the long run. What do you say, fellas?
Hey man, I couldn't agree more with you, George.
Me either.
Shoot.
Very good points.
He just laid it right out there, didn't he?
Right. Sure did.
Man, man, look here, man. This has been fun. Just chopping it up and stuff, and especially when I feel like hopefully we're making an impact and helping people and stuff like that. Because it's a good
Right.
feeling for us on this side, sharing from things that we've read, know, and learned over the years and things that we've invested in. We're not just talking about philosophies here, although I've used the word philosophy many times because I'm not in an advisor capacity. Okay, this is pro bono free. All right, free 99. Now, if you're in my office and I'm giving you some of these nuggets, then yeah, it would be advisory, but that's not what we're doing. We're not advisors. But what we are doing there is sharing with you our own individual experiences, sharing with you knowledge, wisdom, and nuggets that hopefully, if you're listening and you take these things to heart and you start applying some of this stuff, don't just take our word for it. Go to TD Ameritrade, go online and Google and stuff. And I'm not knocking checking out what other people's lifestyles are about and blah, blah, blah. But while you're out there on that internet and that wide world web, man, educate yourself about this system. This system, okay? You got to understand the financial system and investment models and investment processes. People get rich for a reason in these things, man. And you can too. So, fellas, is it that time?
Yeah, I mean, just in just the takeaways, if you take away anything from this podcast, like you say, the key words are diversification, compound interest, and dollar cost averaging. If you just do those three things right there and using some of the vehicles that we've talked about, it'll make it your life very, very successful from a monetary perspective. So, that's my message. So what you got to take us home with?
All right. Well, here's a quote from Mark Twain, and I think it may be very propos in the era of when we're talking about bear markets and stuff like that. And it's this: it's easier to fool people than to convince them that they've been fooled.
Hey, you're absolutely right. You're absolutely
You know,
right.
That said it in a nutshell right there.
yes, yes, we've been fooled, y'all. Come on.
Definitely.
So if you didn't
So,
know, oh,
it's like I said, so as we always say, if you didn't know, now
now
you
you
know.
know.
Now you know.
Peace.
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 This is Dr. Paul Clemens with the Crotchety Old Men Podcast. If you're interested in financial tools to build wealth, and you're interested in ways to maximize your health through holistic alternatives, then you are just the audience that we're looking for. Tune in each week, every Thursday, to the Crotchety Old Men Podcast, where George Crumley, Gary Smith, and I offer you in-depth discussions on health and wealth. Subscribe to the Crotchety Old Men Podcast on Google, Spotify, Apple, iHeartRadio, or wherever you get your favorite podcast.